Imagine this. With no research, just word of mouth, you buy a meme coin. The next morning, you wake up to see it's pumped, and you've made $1 million. You're ecstatic. Your mind races with possibilities. What to buy, how to celebrate. You even help friends and family buying them nice things. But then the euphoria fades. You check your account, and like that, you're down $500,000. The money feels like it's slipping through your fingers like sand. Now, ask yourself, if this happened to you, could you keep it? Do you have the skills not just to hold on to it, but to grow it? Or would you think, that's it. I'm putting it all in a savings account. Saving gives you security. It's the money you need to sleep peacefully at night, knowing you can handle an emergency. Imagine this. Your car breaks down or an unexpected medical bill comes up. Your savings cushion allows you to tackle these challenges without financial stress. But saving alone doesn't build wealth. Interest from the bank often isn't enough to protect your cash against inflation. That's where investment comes in. Investment is about putting your money to work so it grows over time. When most people think of an investor, they imagine someone glued to a screen, trading shares or currencies all day, making huge bets that pay off. But let me be clear, that's not investing. That's speculation, or gambling under a fancy name. Speculation often involves taking on unknown or excessive risks, chasing quick profits without understanding the downside. While skilled traders can make money, it takes years of honing their craft. They invested their time and tested their trading strategies and leaned to mitigate their risks. All of this took a massive time investment. True investing is about committing to steady growth. Think of investment as a life philosophy. It's about delaying immediate gratification for long-lasting rewards. For instance, investing in a high-demand skill like coding, design, or public speaking can provide returns for decades. Imagine a young professional learning public speaking. Over time, that skill could lead to promotions, networking opportunities, or even starting their own business. Good health is another ultimate investment. A strong body and mind give you the energy to chase your goals. A daily 30-minute walk may not seem transformative today, but over months and years, it compounds into better fitness, clearer thinking, and reduced healthcare costs. Time, too, is a currency. Where you spend it determines your future. Consider this. Every hour spent watching mindless videos online or doom scrolling through social medias could instead be used learning a skill, reading, or working on a side project. The small daily actions compound into significant results over time, whether it's financial, personal, or professional growth. Now, all investments involve some level of risk. The key is to understand what you're getting into. True investing is about measured decisions, not blind bets or reckless gambles. Imagine you're crossing a river. You wouldn't step on a rock without first testing its stability. The same applies to investing. Understanding risk means knowing the stability of the ground you're stepping on. Managing risk is an essential skill for any investor. Start by asking, what's the worst-case scenario? And can I handle it? This mindset not only protects your finances, but also builds your confidence. We'll dive deeper into this in a future video. For now, remember, real investment is about creating value over time, not taking unnecessary chances. Here are 3 steps you can take to start your investment journey. Step 1. Defining financial goals. What you choose to invest in doesn't matter as much as whether it aligns with your financial goals. But saying, I want to be rich, isn't a financial goal. It's just a wish. A well-defined financial goal is specific. Clearly state what you want to achieve. A good example of a goal could be to save $50,000 for a house deposit. Measurable. Quantify progress. For example, invest $500 monthly to reach $10,000 in 2 years. Achievable. Ensure it's realistic based on your current situation. For example, pay off $5,000 of debt in 12 months by allocating $450 per month. Relevant. Align it with your life priorities. A good example could be build an emergency fund equivalent to 6 months of living expenses. Time-bound. Set a deadline, for example, build a $10,000 portfolio within 3 years. Take a moment to reflect. What's a financial goal you've been putting off? Write it down now and start making it specific today. Step 2. Choosing the right investment type. The investment type needs to match your interests. Why? Because you'll need to consistently invest time in it to deepen your understanding and make it your circle of competence. Each option has its risks and rewards. The key is finding what suits your financial goals, interests, skill level, and capacity to manage risk. Think of it this way. If you dislike numbers, diving into stock analysis may feel like torture. But if you love real estate, researching properties could feel exciting and energizing. At the same time, it's crucial to assess your skill level and ability to manage risk before diving in. For example, if you're new to real estate, starting with a high-risk development project might be overwhelming and risky. Instead, you could begin by investing in a real estate investment trust or REIT. This lets you gain exposure to real estate while learning about the industry through company communications and reports. As your knowledge grows and your confidence builds, you can progress to owning a rental property, gaining hands-on experience in property management and investment. Similarly, if you're drawn to the stock market but find it volatile and unpredictable, starting with individual stocks may not be ideal. Instead, consider low-cost index funds or ETFs, which spread your investment across a broad market. These options minimize risk compared to single stocks while still allowing you to observe and learn how markets move. Over time, as you develop a better understanding of market behavior and risk management, you can explore more targeted investments with confidence. Step 3. Automating investments. Automation is one of the simplest ways to ensure consistency in your investment journey. Here's why. Consistency. Automation ensures regular contributions without relying on willpower or memory. Reduces emotional decisions. It helps you avoid making impulsive choices based on short-term changes or unexpected events. Encourages consistency. Regular contributions allow you to invest steadily over time, smoothing out the impact of market ups and downs. Saves time. Once set up, you don't need to worry about manually investing each month. This frees you to focus on the big picture. Think of it as setting up an irrigation system for your financial garden. Once in place, it ensures your investments grow steadily without constant oversight. Imagine the peace of mind knowing your future self is being taken care of, even on days you're too busy or forgetful. What kind of investor do you want to be? Are you willing to take small, consistent steps to find out? Remember, true investment is about growth. Financially, making your money work for you. And personally, becoming the best version of yourself. Avoid the trap of speculation and focus on building real value. What's your next step? Are you investing in stocks, real estate, or perhaps your own skills or your health? Share your plan in the comments, and don't forget to subscribe for more timeless advice on building your future. Our next video will be on risk and its nature, video coming out soon. Are you ready to join us on this journey? Are you ready to win? Come and join us. If you're enjoying this content, show some love. Hit the like button and give it a thumbs up.